Good morning, everybody. It's great to be here. My name is Estreicher. I'm with VanEck. First, a quick thank you to our friends at Trinity Fiduciary for allowing us to participate today. I was at lunch about a year and a half ago with Dan Mulvey at the Magic Mushroom Pizzeria, and he mentioned the idea of putting together a faith-based investment summit. And I thought it was a fantastic idea, and I look around the room today, and it's remarkably well executed, and I've decided that that was the best idea that ever came from the Magic Mushroom. So today I'm going to talk about VanEck's role in impact investing, and we're going to approach this from a little bit of a secular perspective. I'm going to talk about our green bond ETF. But as a quick background, I'm one of the 5 ETF specialists at the firm, and I work directly with asset managers like Trinity, investment advisors, and then multifamily offices. This is my, I guess next month will be my 4th year at VanEck, and prior to that I was with a market-making firm out of Chicago where we provided liquidity and aggregated liquidity for some very large ETF strategists. So I've been on the ETF side of the world for about 8 years now exclusively. As a quick update on VanEck, for those of you who might not be too familiar with us, we're a global multi-asset investment manager specializing in delivering some very targeted, differentiated, and complete exposures to the marketplace through a variety of different types of product wrappers. So today we manage anywhere between 47, maybe 46 billion, depending upon the week-over-week flows. 10 billion of that is comprised in our 7 active mutual funds, and then the balance is in our 60-plus ETF suite. Some of you may know us from our GDX ETF, the gold miners, which is essentially was the genesis of the ETF business back in 2006. So our firm does have a rich history in gold mining and hard assets investing, but today we do have a comprehensive suite of solutions in just about every major asset class. Since I mentioned that we do manage about $47 billion, I think a good question is how exactly are we a top 10 issuer playing against multi-trillion-dollar players? And a couple of years ago I was with one of my other asset manager clients, and I asked that question to our CEO, and he so eloquently responded, we would like to be viewed as the craft brewer of ETFs. And I thought that was adequately put, because when you think about what we do, we are not your broad, cheap core, meaning that we're not going to roll out cheap beta and then continue to reduce expense ratio to protect our market share. What we do is been created to cover gaps in the marketplace or constructed for what portfolios may someday look like in the future, and then every now and then we will reconstruct a product to deliver a more efficient exposure to the marketplace, in our opinion. Another item that might be unique is that we do maintain a sister company out of Frankfurt called Market Vectors Index Solutions, where we're able to self-index. As an investor, you can imagine licensing an index can be a significant component of the overall expense ratio, so we self-index where and when appropriate to pass back a lot of those cost savings to the client. But today here, we're going to talk about impact investing, and really that's ESG and the evolution of SRI 2.0. I'm not going to throw a million acronyms at you, but ESG still obviously incorporates a lot of the socially conscious and environmental factors, but it also incorporates corporate governance and corporate behaviors such as board diversity, executive pay, business ethics, if you will. But our role at VanEck is only in the environmental piece for now. Really isolating that E variable in the ESG equation. And believe it, the irony is absolutely not lost on me. VanEck is a firm who has been colloquially known as the golden oil guys over the past 50 plus years, and now we are a clear leader in pioneer investing in the ESG space, because we have just launched the green bond ETF back in March of 2017. So we'll go into the green bond market a little bit. So what are green bonds? Nothing different than a conventional bond, except that the proceeds have to be designated for environmentally friendly purposes and pursuant to the green bond principles. So on this slide you can see some of the common uses that some of these proceeds can finance. Renewable energy projects such as wind or solar, energy efficient buildings, clean and low impact transport, and then waste and water management are some of the top uses of these proceeds. In 2014, S&P launched their Green Bond Index, and in 2016, we engaged with them to rework the index to make it more investable. And then in February of 2017, we rolled out the Green Bond Select Index. We put some parameters around liquidity, maturity, credit quality, and currency, again, to make it more inherently investable. And when you roll out a passive ETF meaning that it seeks to replicate or track an index minus fees and expenses. That index has to be broad, deep, liquid, and complete. From the standpoint of the coverage universe, green bonds represent about $320 billion in total AUM, which is just a very small fraction of the global ag. Even though we do have about a 9% representation of the 3,300 bonds outstanding, we do have a market value representation of over 70%, so still very good adequate coverage. I want to fast forward to this slide, which is really the crux of the presentation, and one of the reasons why green bonds are quite different. So I think the biggest challenge associated with ESG to date has been subjectivity. While there have been several firms that have put together Sustainalytics and variety of metrics to rank certain constituents, eligibility at the end of the day is ultimately determined by the end investor themselves. And just a quick anecdote to substantiate some of that subjectivity, researchers at MIT have been working on what they call the aggregate confusion project, where they compare the top 5 ratings agencies and they compute a rank correlation of all the constituents that they rate, and they found a correlation of 0.1 to 0.15, meaning that 5 to 10% of the highest rated companies of one agency could actually potentially fall in the bottom 20% of another ratings agency. So there's really no standard here. But green bonds are different in that there is a global standard that governs eligibility and governs definition. In 2014, the International Capital Markets Association rolled out the Green Bond Principles. And the Green Bond Principles were developed to help promote transparency, integrity, and really the growth of the green bond space. And there are 4 components to the Green Bond Principles on the left side of the screen. And they're fairly intuitive. The use of proceeds. What exactly is the bond intended for? Number 2, what was the process that you used to determine sustainability objectives will be met? Number 3, the management of proceeds. This is a crucial one. Once you issue the bond, what happens? Those proceeds need to be ring-fenced. They need to be credited to a sub-account or sub-portfolio, and then they need to be tracked to ensure that disbursements match the project needs. And then the last piece is reporting. And originally this was done internally and typically on an annual frequency, and with any type of updates would need to be immediately reported. But there have been pressures over the past couple of years for issuers to engage with third parties. We call them external review providers, to engage to continued compliance and alignment with the Green Bond Principles. There's another organization, the Climate Bonds Initiative, that plays an integral role in this space as well. So they have dedicated to maintaining a database of all of the green bonds that have been issued globally. And they also maintain a taxonomy as well. And that taxonomy is ever evolving, but it also helps to ensure continued alignment and compliance with the Green Bond Principles. The taxonomy does help resolve a lot of conflict areas or gray areas. I'll give a few examples. So energy efficiency, that seems to be a no-brainer. However, if the proceeds of that bond would be put toward a technology that will help an oil company maximize output by drilling further into the earth, that would be excluded. Anything nuclear is typically excluded. The risk of a reactor meltdown wiping out an entire ecosystem, and then of course there's challenges associated with waste disposal. And then lastly, hydropower as an example, particularly large-scale hydro, while very clean, very renewable, if you have to chop down an entire rainforest in Brazil to build it, that's not going to work either. So these guidelines are very helpful in launching a credible green bond. The next slide talks a little bit about the growth in the space, and I'll just give a quick highlight. 2007, that was the beginning of the first green bond was issued by the European Investment Bank, which is a supranational organization. Supranationals and developmental banks dominated issuance for the next 6 years. And then in 2013, we saw the very first non-financial corporate come to market, and putting the space around $19 billion in total. From 2013 to 14, a significant jump. That was essentially the next wave of growth for the green bond space. The market doubled to $38 billion. In 2016, we saw sovereigns finally enter the marketplace, Poland with a $750 million euro issue, and then France came into the market in January of 2017 with the largest issue on record at $7.6 billion. And then they tapped the market 2 more times that year for a total outstanding issuance of $10.7 billion. Other sovereigns finally joined this year in 2018 in March to help push the category to $14 billion. And we estimate about $250 billion of green bond issuance in 2018 alone, and we just crossed the $100 billion mark, so we are a bit behind. The next slide talks a little bit about diversity of the issuer base. And as you can see, the green bond marketplace has become increasingly diverse with a wide variety of issuer representation. Corporates, both financial and non-financial, represent about 45% of the universe. And then from a use of proceeds perspective, you see renewable energy, energy efficiency, and clean transport representing about 80%, with waste and water management representing about another 15%. So that's the where the bulk of the proceeds have been allocated. To put this into context, I can give you guys a few examples of some of the proceeds inside of the Green Bond Select Index. As a good sovereign example, the French Republic projects include R&D for new energy technology, clean transport and conservation, the continued promotion of biodiversity. A good supranational example is the European Investment Bank. They're constructing energy efficient buildings that will avoid over 18,000 kilotons of greenhouse gas emissions per year. And then we have two corporate examples, Apple and Bank of America. Apple is constructing 4.7 million square feet of green buildings that will seek to avoid more than 450 kilotons of greenhouse gas emissions per year and water savings of over 95 million gallons. Bank of America, they've engaged in solar and wind projects to save 890 kilotons of greenhouse gas emissions per year, which will power more than 300,000 homes annually. And these are only a fraction of some of the projects that investors can have access to. And I'll conclude with my final slide, and this really compares the Green Bond Select Index to the global ag. Very similar characteristics from the standpoint of yield and duration, as well as performance, but there are some noteworthy differences. First is currency exposure. As the Green Bond Select Index is underweight USD, overweight Euro, and has very little exposure to yen. Japan has been late to the game, but finally in the second quarter of this year issued some eligible bonds for our index, so we're now sitting at around 3% yen from 4 different issuers. Credit quality is another difference, so we do maintain, we have the ability to go to 20% high yield, but right now we have about a 4% high yield. The global ag does not have any. And then issuer type diversification, I talked a little bit about this. Issuers are capped at 10% in the index, and we have we're grossly underweight sovereign, about 6% allocated there, given they just recently entered the marketplace. But we are overweight in supranationals, agencies, and local authorities, which totals about 60% versus the global ag, which has about 11%. So in the interest of time, I'm getting flagged here, I will conclude with one last point. When you think about ESG in a portfolio context, and this has been touched on already several times this morning, there's really 2 ways to look at it, and we do think green bonds offer a distinct advantage. So the first, the more conventional approach is exclusionary, the avoidance of those companies that would potentially engage in those activities causing environmental harm. Now, it certainly makes sense, but there is a downside to that because when you're excluding certain industries and subsectors, you're now introducing the component of tracking error. And that may not be very desirable from an institutional investor's perspective because they could be held to tracking error constraints. So the only way to really mitigate tracking error in that scenario is to tilt the portfolio away from some of those problem constituents in hopes that that underweight position would be noticeable enough to pressure those organizations to make the necessary changes to their behaviors. The second approach, which is equally as stringent, is inclusionary, and that's to only invest in those companies or in the assets of those companies that have made a move toward a more sustainable or low impact economy. And we think this is desirable for 3 reasons. One, now you can mitigate the component of tracking error because you no longer have to exclude certain industries or subsectors regardless of the primary business type of that issuer, providing the proceeds of those bonds in the case of green bond are going to something that would be deemed environmental friendly, so the investor can be rest assured that their allocation would be put towards an initiative that would match their mission objective. An example of a company heavily reliant on coal, they could use green bond issuance to fund the transition to a more renewable energy source. The second reason we think this is beneficial is more regulatory in nature, and it could help from a reputational standpoint as well. Companies that are already engaging in ESG-friendly business practices or companies that have an outstanding green bond are likely positioning themselves in a way to reduce risk from upcoming regulatory changes, almost acting as a regulatory hedge, if you will. And then the last benefit we think is that the inclusionary approach is more forward-thinking. And you can make the argument that the use of proceeds-based investing is compelling, but we think it's the most forward-looking measure because you're investing in the funding of future projects and future initiatives versus the conventional scoring method, which is at the company or issuer level, which is based on the surveys of previous behaviors. So with that, I will conclude, and I guess we can move on to the panel.